All right, how's everybody doing tonight? Doing good? Good. Well, as Nolan mentioned, my name is Chaz. I'm a certified financial planner here at America's Retirement Headquarters, and I'm happy to see everybody. By a show of hands, how many people were here at our last economic summit in October? A couple of you think definitely, yeah. Awesome. We're glad you guys were able to make it back. Wow, what a difference 6 months really makes, doesn't it? It's just such a different time right now. 6 months ago, the room looked different. But now, as we're getting into this new year, we thought we were kind of transitioning and turning the corner from COVID in 2020 and 2021, and then we turned the corner in 2022 and we run right into a wall. So that wall obviously is the Ukraine and the Russian crisis, and I just wanted to take a minute today and just kind of send our heartfelt thoughts and prayers to the folks that are in Ukraine, the citizens that have been displaced. Just the amount of heroism and just the strength that the people are showing there is amazing, and it is just truly inspirational. So just wanted to say that. On a lighter note, I've been doing quite a bit of research on the topic, and I didn't know this, and maybe many of you knew this, but the President Zelensky, does anybody know what his previous career was before he was a politician? Comedian, yeah, definitely. So it's amazing how the comedian becomes the world leader, and some of the world leaders sometimes become comedians. But that's just the way, that's just what's going on. So, but what I wanted to talk about today is, how do we as individuals and as Americans continue to, meet the goals that we have for our families, even in downtimes, even in times of economic and global uncertainty. But then as a whole, as Americans and as a nation, how do we, continue to offer that strength to our partners in democracy around the world? And so that's kind of what we're going to talk about a little bit today, is some non-traditional assets, alternatives. And I thought it was apropos with the topic of love being the topic of the seminar that we talk about. One of the ways that you show love for your family members and friends is by giving them gold. And so we're going to talk a little bit about how you can show your portfolio some love by also adding in gold and precious metals. So we're going to start off with just a disclaimer, of course, in that this isn't official advice. Official advice should be given in the context of your overall situation, and that past performance doesn't ever mean future results. All right, so we're going to talk a little bit about gold as just a measure of performance and how it's performed as amongst other asset classes. And you can see squarely there in the number 2 position, gold has been a great performer in the last 20 years. It's number 2. And so, looking at it long-term perspective, gold is still a really good investment to hold for long-term performance. Kind of more so updating, getting up to speed today. Nickel, I don't know if you guys are familiar with this, but nickel has actually doubled in price just almost overnight. It's a major component in developing the electric cars. And so, it's just kind of showing you that right now it's a trend that we're seeing. It's performing well, and it's one that has also had a long-term track of positive performance. So also, we want to talk about gold as that safe haven asset. And as, we continue to spend, many presenters today, Nolan has talked about the amount of spending that the United States is going through right now. That's obviously concern, as Joshua talked about as well. The more dollars that are available in the economy, the more that inflation, we're going to see the cost of goods and services go up. And so gold has traditionally been a great store of value and has kept up with the Federal Reserve. You see here the almost parabolic increase in spending that we've experienced in the United States. And so historically, gold has been a great safe haven for that. It's a store of value. You can't inflate gold. They're not producing more of it. So that's something to consider as well. And a lot of the presentation that we're going to talk about today is not for or against gold. That's not really the point of the presentation today. It's just to really give you some things to think about and some considerations to talk about with your financial advisor, and just to kind of determine a strategy that makes sense for you. So this is one of them. So any investment that can hold its salt is going to keep up with the dollar and inflation. And so you can see here, this chart kind of shows the dichotomy of the US dollar and gold prices. So as the dollar continues to weaken, gold prices tend to go up. And as I was checking the presentation, 3 weeks ago we were developing this presentation, gold was already up about 6% for the year so far. It's continued to increase in price. It's offering some opportunities for investors that, not as a wholesale switch. We would never recommend moving wholesale, changing strategies completely, but in the context of your overall strategy and properly diversifying, maybe adding other risks to help offset the overall risk of the portfolio, gold is presenting some opportunity. That's really a measure of diversification. What you want to see is not all the positions in your portfolio go up. We want some to go up when others are going down, and ultimately you end up reducing overall risk. Okay, and so gold and inflation, again, you can see that the price of gold has historically kept up with the inflation, the rate of inflation, which we see is definitely picking up. I think the rate of inflation is last month over 7%. The historical figure that we use is typically around 2.5% to 3%. So, and oftentimes, a lot of people don't know this, but the inflation, the measure, the index that we use to track inflation is called the CPI, which doesn't include food or oil or anything like that. So, it could be a lot higher when we actually add those other items into the index. But gold has been traditionally a good way to keep up with inflation. Okay, so why should you consider adding gold and precious metals to your portfolio now? Well, there's a lot of fundamentals that are at work. Obviously, the global currency devaluation. What we're doing in the United States here of printing more money is actually being done all over the globe. So it's not just a trend that we're seeing here in the United States, but we're seeing it across the globe as well. Inflation, geopolitics, the conflict in Ukraine. All of these factors are fundamentals that are at work and that could possibly contribute to some opportunity for growth in some areas of your portfolio. Supply and demand factors, we talked about that with Josh earlier. So we're going to look at each one of these, but first let's talk about the disadvantages, because any opportunity always comes with risks. There's disadvantages and advantages to everything. So one of the major advantages of owning actual gold bullion, and we refer to the bullion, the gold cougar ants, or maybe a bar of gold possibly, but the disadvantage is that gold doesn't pay a dividend. So a lot of retirees actually live on the dividends that our portfolios provide. Gold doesn't do that. Oftentimes it doesn't have a dividend that you can live on, that you can draw and use to pay for expenses. Similarly, it doesn't pay interest. So you can't really rely on that as a vehicle to provide for monthly expenses or covering your monthly expenses. So main disadvantage here is that it does not pay dividends. Dividends and interest also. So unlike most stocks and bonds, you can draw an interest. You can draw a dividend from a stock and bond portfolio. So that is definitely something that you want to consider. The only earned income that you have from gold is if you sell it for more than what you paid for it. You can't walk into a Kroger's and pay for your groceries with a gold coin or something like that. It'd be cool if you could, and I often say it's nice to look at, but really the utility of gold is just very limited. So this can actually be taken as a positive and a negative to owning gold in your portfolio. So gold is a tangible asset. It is something that you have to physically hold in order to have the value. So you can take it as a positive. On one hand, you actually own something. You have that tangible asset like real estate, where you have possession of it. You know that it exists. It's not out on the cloud or somewhere or in a digital form. However, it begs the question of what are you going to do with it? Where are you going to store gold? Are you going to keep it in your home? Are you going to keep it in a bank vault or something like that? And if so, are there additional costs associated with saving, putting gold in your lockbox? I sometimes talk about if you really needed to get at it, if you needed to get the gold and there was a run on the bank or something like that, would you be able to get in and get it? So you need to have a place, you need to have a plan in place to store the gold as well. Also, positive or negative, depending on what side of the fence you're on. But there really is no physical record that you purchased that gold, that you own that. So it also doesn't cover, it's not covered under SIPC, which is the Security Investors Protection Corporation. It's the protection that you have as an investor against a default of the broker-dealer. So there's no physical record of it, which means unless you are in physical possession of it, it doesn't exist. Now, on the opposite side of that coin, if you prefer to have a bit of anonymity, in your financial situation, you don't want everything out there on the web or in digital format that can be, misappropriated or stolen, your identity, gold does offer a measure of protection from that risk. So how can we help? What can we do? If owning the actual physical gold bullion is not the solution that works best for you, there are a couple of other ways that we can help you add gold to your portfolio and use it more as a hedge against further downturn in traditional assets like stocks and bonds, but also to take advantage of an opportunity that we might see that will continue on into the future. So there's a couple different ways that you can actually participate in the gold trade without actually owning physical gold. The first would be to own mutual funds. Mutual funds are pooled investments that would own the companies that actually pull the gold out of the ground and they bring it to the market. So you can own the companies that actually refine it and bring it out of the ground and sell it to you. Now there's some advantages with mutual funds, but essentially mutual funds are a pooled investment. They have their own disadvantages and advantages. You want to talk about which makes the most sense with your advisor. Also, ETFs. One of the biggest investments in gold right now is an an exchange-traded fund, and the actual underlying investment. Exchange-traded funds are very similar to mutual funds. Traditionally, they are a little bit lower in cost, and they don't have that same cost structure that typically makes is a disadvantage for mutual funds. But the underlying investment in that ETF is gold bullion. So it is stored in a secure location off-site, so you can participate in the price appreciation of gold through owning this ETF that we could talk about. You can also buy futures. You can speculate on the price of gold in the future, and you can also own the actual stocks. Again, the stocks that bring it out of the ground and bring it to the market. So there's a lot of different ways that we can help you to participate in owning gold and further diversifying your portfolio. It's just a matter of really talking about, again, the advantages and disadvantages for you and coming up with the strategy that makes the most sense. Other ways that we can help, and I would say more traditionally, is just very simple. One of the other advisors in the office here uses the acronym KISS. I'm sure you're all familiar with it. Keep it simple, stupid. Keep it simple, silly, whatever you want to use. But keeping it simple in times of volatility and increased stress in the markets, having a balanced strategy, 50% stocks, 50% bonds has historically been one of the best ways to counteract volatility in your portfolio. Over a 5-year period of time, traditionally you've got about a 70 to 75% chance of making some money in a balanced portfolio. The further out your time frame is, 3 to 5 years, all the way out to 10-year time frame, you're looking at about an 80 to 95% chance of some success in the market, just using a balanced strategy. Very simple. Also commodities, we talked about it, the nickel, a barrel of oil. A barrel of oil today, I think, topped over $135. It's one of the highest prices that it's been historically. And so commodities, are definitely an option in terms of how to add some alternative investments to your portfolio. You know, typically, we wouldn't say probably more than 5 to 10% you should be looking at and adding alternatives to your strategy, to your overall, investment strategy. Real estate investment trusts. I know a lot of clients own real estate investments. Traditionally, they are also fairly uncorrelated to the markets, and they have an income stream. So for retirees, one of the main goals is that we have income coming in, multiple sources of income that you can live on, and REITs can offer that as an opportunity for you to not have to sell your investments in a downtime, but have income coming in to cover your expenses. And as Nolan talked about, government I-bonds, inflation-protected securities that traditionally, as the CPI or that consumer pricing index we talked about, which measures inflation, as that goes up, that your bond interest is also going to float up with that. So there's a lot of different ways that we can help you feel more comfortable about your financial situation. If you are a little bit nervous, if you're considering making some wholesale changes to your portfolio, going all the way to cash and trying to time the market, that's never made sense. Traditionally, that's probably one of the worst decisions you can make. But by leaning into some sectors of the economy or leaning out of other areas, maybe augmenting your portfolio with more risk, such as alternatives, or balancing the portfolio out, would oftentimes, and history has shown us, makes a little bit better, is a better choice for your long-term success. So, with that, again, on the table, you do have our cards there that have the QR code. You can scan that QR code and schedule an appointment if you're a client of mine or you're just interested in learning a little bit more about gold and precious metals, how it fits into your strategy. Scan the QR code there and you can schedule an appointment with myself or one of the other advisors here at America's Retirement Headquarters. So with that, I appreciate it, and I think we're going to hold questions for a little bit later.
Yeah, thanks so much.
Perfect. Thank you, sir.